Welcome back. In today's video, we're diving into the fascinating world of Microsoft and exploring the question, could Microsoft become a $5 trillion company? That's right, you heard it correctly. Stick around as we break down the valuation and outlook for Microsoft. And trust me, the company is definitely an AI hot pick. So, let's jump right in. As one of the leading AI elites, Microsoft has seen its shares skyrocket this year, leaving investors pondering if they're overvalued. To determine this, let's start by understanding what the market is pricing in. I've used a reliable valuation framework and deployed two approaches to help us decide if the market's expectations are realistic or not. I've also taken a completely different approach to envision just how big Microsoft could become. Before we dive into the details, let's first look at the growth rate already priced into Microsoft's stock. The price-to-earnings valuation is currently at a 32 times multiple, nearing its 20-year high. However, price-to-earnings ratios based on past or near-term profit forecasts aren't that useful for valuing growth companies like Microsoft. So, to get a clearer picture, we'll conduct a reverse discounted cash flow analysis. A conventional discounted cash flow predicts a firm's cash flow for a set number of years and assumes a forever growth rate after that. By playing with these growth numbers in a reverse discounted cash flow, we can determine what the market is currently assuming. Using last year's cash flow as a starting point and a 7.5% discount rate, we find that the market is assuming roughly 10% growth in cash flow for the next 10 years, followed by a 2.5% expansion thereafter. But let's not stop there. To provide more context, let's explore a couple of quick ways to evaluate the reasonableness of this 10% growth rate. First, we can look back over the past 10 years and examine Microsoft's impressive performance. Since 2013, Microsoft's cash flow has grown by over $40 billion, averaging just over 10% annually. Considering the momentum gained from cloud computing, it's reasonable to believe that Microsoft's future growth could at least match its past. Secondly, we can estimate the size of the total addressable market. With the global economy projected to grow, Microsoft's share of the IT spending market could increase significantly. Assuming Microsoft holds its current share, sales could reach $640 billion in 10 years, a 190% increase from current levels. And if Microsoft's share were to grow to 6%, we could be looking at sales of around $770 billion, representing an annual growth rate of 13%. But why stop there? Let's take a bottom-up approach and explore the potential for Microsoft's products. With approximately 350 million users of Microsoft's commercial office products, there's tremendous room for growth. If Microsoft's AI-infused software saves knowledge workers a couple of hours each day, the productivity savings could be substantial. Let's assume Microsoft keeps $5 of the $80 saved per worker per day, resulting in an additional $546 billion in annual revenue. When you factor in Azure, Microsoft's growing cloud business, and its consumer segment, including gaming, we could see Microsoft's revenue closing in on $1 trillion in 10 years. Even with a conservative valuation, that would still make Microsoft a $5 trillion company. Now, it's essential to acknowledge that there are risks and uncertainties surrounding these assumptions. Microsoft is still exploring the full potential of its AI-infused products, and there's always the possibility of unforeseen obstacles. Additionally, any significant issues or setbacks with AI technology could impact the entire sector. However, when we analyze the current investor expectations using different lenses to detect a potential bubble, we find that Microsoft's 10% growth rate seems plausible. In fact, it suggests that Microsoft's stock is not in bubble territory. To recap, based on a reverse discounted cash flow analysis, investors are anticipating roughly 10% cash flow growth for the next 10 years, followed by 2.5% thereafter. Considering Microsoft's track record, the potential increase in IT spending, and the opportunity to capture AI-driven productivity savings, it's evident that Microsoft's valuation is not unrealistic. And that wraps up today's video. I hope you found this exploration of Microsoft's future prospects intriguing. As always, remember to take into account the risks and uncertainties involved. If you enjoyed this video, don't forget to like and subscribe to my channel for more exciting content. Until next time, keep exploring and enjoy investing.